Your cash is dying. Not tomorrow, not next year. Right now, this minute as you read these words. On Friday, January 30th, 2026, at 6:47 a.m. Eastern Time, President Trump posted a single message on Truth Social, 8 words that ended a 53-year era. Kevin Warsh will be the next Fed chair. The dollar index fell immediately, not a crash, a controlled descent, the kind that kills slowly. By market close, the DXY had broken through support levels that held since 2022. This wasn't volatility, this was a structural shift. The world's reserve currency, the asset backing every dollar in your wallet, every digit in your bank account, every promise your government ever made, just lost its last defender. Jerome Powell fought, Kevin Warsh won't, and the difference between those two men will determine whether your savings survive the next 12 months. Welcome to the flow of money. This is not a prediction. This is documentation of a monetary regime change happening in real time. The mechanics are simple, the consequences are catastrophic, and the window to protect yourself is closing faster than most people realize. Let's walk through what just happened, why it matters, and what you need to do in the next 72 hours before the implications become irreversible. The Federal Reserve was created in 1913 with one explicit mandate: independence. The central bank would operate at arm's length from political pressure. Presidents could appoint governors, yes, but once confirmed, those governors answered to economic data, not political demands. This wasn't idealism. This was engineering. The designers of the Fed had studied history. They knew what happened when politicians controlled money supply. Weimar Germany, the Roman Empire. Every civilization that let leaders print their way out of fiscal responsibility ended the same way. Hyperinflation, currency collapse, societal breakdown. So the Fed was built with walls. Thick institutional walls separating monetary policy from the White House. For over a century, those walls held. Presidents complained, certainly. Nixon grumbled. Reagan pushed back. Even Trump during his first term criticized Powell loudly and frequently. But the walls held because the institution held. Until now. Kevin Warsh is not Jerome Powell. Powell came from private equity, yes, but he absorbed the Fed's institutional culture during his years as governor. He understood that his job wasn't to make the president happy. His job was to manage inflation and employment, even when those goals conflicted with political timelines. Warsh is different, not in background. His resume is impeccable. Stanford, Harvard Law, Morgan Stanley, Fed governor from 2006 to 2011. On paper, he's qualified, but qualification isn't the issue. Loyalty is. Trump interviewed multiple candidates for Fed chair. Rick Reeder from BlackRock, Chris Waller, already a Fed governor, Kevin Hassett, his own economic advisor. He chose Warsh for one reason. Warsh publicly called for regime change at the Fed. He criticized Powell not just on rate decisions, but on institutional philosophy. He argued the Fed had become too cautious, too academic, too disconnected from what he called real economy needs. Translation? The Fed wasn't doing what Trump wanted, and Warsh signaled he would. Now let's talk about what Trump wants. Lower interest rates, not carefully calibrated reductions based on inflation data, aggressive cuts, deep cuts, the kind that juice economic growth in the short term, regardless of long-term consequences. Why? Because economic growth before the 2028 election helps Trump. What happens after 2028 is someone else's problem. This isn't speculation. Trump has stated this explicitly. In interviews, in social media posts, in conversations leaked to the press. He believes the Fed should support presidential economic policy, not oppose it. He believes central bank independence is an outdated concept that handcuffs American competitiveness. And he just appointed a Fed chair who publicly agrees with him. Here's the mathematical problem. Right now, core inflation in the United States is running at 3.2%. The Fed's target is 2%. We're not there yet. Under normal circumstances, a responsible central bank would hold rates steady until inflation actually reaches target, maybe even raise rates if inflation proves stickier than expected. But Warsh takes office in May, and market analysts, based on his recent statements and Trump's explicit demands, expect the first FOMC meeting under Warsh's leadership to cut rates by 50 basis points, not 25, 50, 0.5% in one meeting. Why? Not because inflation hit target, not because employment collapsed, because the president wants growth. This is the Arthur Burns playbook, and anyone who studied economic history knows exactly how that story ends. Arthur Burns became Fed chair in 1970, appointed by Richard Nixon. Nixon wanted to win re-election in 1972, and he wanted economic growth to secure that victory. He pressured Burns relentlessly. Keep rates low, keep the economy hot. Burns complied. Interest rates stayed low through 1972. Nixon won re-election in a landslide, and then the bill came due. By 1974, inflation was accelerating. By 1975, it was out of control. By 1980, the inflation rate hit 15%, 15%, the worst inflationary episode in modern American history. It took Paul Volcker, Burns's successor, years of brutal monetary tightening to kill that inflation. Unemployment spiked to 10%. Recessions came in waves. An entire generation learned the hard way that you can't print prosperity without eventually paying the price. We're about to learn that lesson again. The only question is whether you'll be positioned to survive it or destroyed by it. Let's examine the dollar itself. The DXY, the dollar index that measures the greenback against a basket of major currencies, closed Friday at its lowest level since October 2023. That might sound abstract. Let me make it concrete. When the dollar falls, everything priced in dollars becomes more expensive. Oil, natural gas, wheat, copper, every commodity traded globally. The United States imports approximately 40% of its consumer goods: clothes, electronics, furniture, vehicles, all priced in dollars on the international market. When the dollar weakens, those imports cost more, which means the prices you pay at Target, at Best Buy, at the car dealership go up. This isn't inflation caused by demand. This is inflation imported through currency devaluation, and it's already starting. But there's another mechanism at work, a more dangerous one. The rest of the world is watching. For 50 years, global central banks held dollars as reserves because the dollar was stable, backed by the full faith and credit of the United States, managed by an independent Federal Reserve that prioritized price stability over political convenience. That was the deal. Countries held treasury bonds, traded in dollars, pegged their currencies to dollars because they trusted the system. That trust is breaking. China has sold more than $200 billion in treasury bonds over the past 18 months. Russia reduced its dollar holdings to nearly zero. Even traditional U.S. allies like Saudi Arabia are quietly diversifying, accepting yuan for oil sales, discussing local currency swaps with trading partners, building alternative payment systems that bypass SWIFT. This is called de-dollarization, and it's accelerating. When Kevin Warsh's appointment was announced, financial analysts in Beijing, Moscow, Riyadh, they didn't panic. They smiled. Because Warsh represents confirmation of what they've suspected for years. American monetary discipline is over. The Fed will serve political interests, not economic stability. And if the Fed can't be trusted to defend the dollar's value, why hold dollars? This creates a feedback loop. Foreign central banks sell treasuries. Treasury prices fall. Yields rise. The US government's borrowing costs increase. The deficit widens further, which requires more borrowing, which floods the market with more treasuries, which drives prices down further. This is a doom loop, and we just entered it. Now let's talk about what this means for the cash sitting in your bank account. You think it's safe because the number doesn't change. You had $50,000 last week. You have $50,000 today. Same number. But the purchasing power of that $50,000 is evaporating. If inflation runs at 6% annually and your savings account pays 2% interest, you're losing 4% per year in real terms. Compounded over 5 years, that $50,000 becomes worth $41,000 in today's purchasing power. You didn't spend it. It just disappeared, vaporized by the gap between inflation and your interest rate. And when Warsh cuts rates aggressively, that interest rate you're earning drops even further while inflation climbs. The gap widens. The destruction accelerates. This is theft, not the kind with masks and guns. The quiet kind, the legal kind, the kind governments have been using since currency was invented. It's called seigniorage, the difference between the face value of money and the cost to produce it. When the Fed prints money either literally or through digital expansion of the money supply, it dilutes the value of every dollar already in circulation. Your paycheck is denominated in dollars, your savings are denominated in dollars, your mortgage, if you have one, is denominated in dollars. When the supply of dollars increases faster than the supply of goods and services, each dollar buys less. This is not theory, this is arithmetic, and the Fed is about to accelerate the printing. Here's how it works mechanically. The Federal Reserve doesn't literally print cash. Most money creation happens digitally. The Fed buys assets, primarily treasury bonds, from banks. The Fed credits the bank's account with new money. That money didn't exist before. It was created from nothing. The bank now has more reserves which it can lend out. The loans create more money through fractional reserve banking. $1 of Fed creation becomes $10 in the broader economy. This process, called quantitative easing when done at scale, expands the money supply. When the money supply expands faster than economic output, prices rise. It's that simple. The Fed has been relatively restrained in recent years, actually shrinking its balance sheet through quantitative tightening. But Warsh's appointment signals that restraint is ending. Trump wants growth. Growth requires credit. Credit requires lower rates and expanded money supply. Warsh will deliver, and your cash will pay the price. Let's examine the international dimension more carefully. The petrodollar system, created in 1974, was the foundation of dollar dominance. Saudi Arabia agreed to sell oil exclusively in dollars. In exchange, the United States provided military protection and political support. Every country that wanted to buy oil needed dollars. This created permanent global demand for the currency. Even if you were Japan, buying oil from Saudi Arabia, you had to acquire dollars first. This system gave the United States an extraordinary privilege. We could print dollars, and the world would accept them because the world needed them. We exported inflation, we imported goods, we ran perpetual trade deficits that any other country would find unsustainable. But we were special. We had the reserve currency. That system is dying, not because of military defeat, because of monetary suicide. On January 3, 2026, US forces captured Venezuelan President Nicolás Maduro. The operation was swift, surgical, controversial, but the economic implications were clear. Venezuela sits on the world's largest proven oil reserves. With Maduro gone and a transitional government friendly to Washington, those reserves potentially come back online under US oversight. More oil supply should lower prices, yes, but there's a second effect. It reinforces the petrodollar. Venezuela will sell that oil in dollars to American companies. That's additional global dollar demand. Seems positive for the currency, except for one problem. The rest of the world saw the Maduro operation not as law enforcement, but as regime change. China condemned it, Russia called it illegal aggression, Iran pointed to it as evidence of American imperial overreach, and the message those countries received was clear: the United States will use force to protect dollar dominance. Which means diversifying away from dollars isn't just economically prudent, it's a national security imperative. Saudi Arabia is watching this closely. The kingdom has been in discussions with China about yuan-denominated oil sales for 3 years. Those talks were theoretical, exploratory, slow. After the Venezuela operation, they accelerated, because Riyadh understands that if Washington will topple Maduro to secure oil pricing, Riyadh's own relationship with the US is purely transactional. The moment Saudi interests diverge from American interests, the protection could vanish. Better to diversify payment options now. Better to build relationships with Beijing now. Better to reduce dependence on a currency managed by a Federal Reserve that just lost its independence. The Saudis aren't moving quickly, they're moving carefully, but they're moving, and each step away from exclusive dollar pricing chips away at the foundation that's supported American monetary hegemony for half a century. Meanwhile, gold is sending a signal. On January 29th, gold hit $5,600 per ounce, an all-time high. Then on January 30th, the day Warsh's appointment was announced, gold crashed 11% in a single session, the largest one-day decline since 1980. Silver fell even harder, down 30%. The mainstream narrative blamed profit-taking, blamed technical factors, blamed over-leveraged speculators forced to liquidate positions when margin requirements suddenly increased. All true, but incomplete. Because while paper gold and paper silver crashed on exchanges, physical metal became impossible to buy. Coin dealers reported 4 to 6 week delays. Premiums over spot price jumped to 20%, sometimes 30%. This disconnect between paper price and physical availability tells you everything you need to know. The crash wasn't demand disappearing. It was leverage being violently unwound, weak hands shaken out, retail investors scared into selling, and sophisticated buyers quietly accumulating the physical metal while prices temporarily collapsed. Central banks are still buying. China added over 200 tons of gold to its reserves in the past year. Not selling, buying. Russia continues to accumulate despite sanctions that make transactions difficult. Poland, Singapore, India, Turkey, all building gold reserves at rates not seen in decades. These are not stupid institutions. These are central banks with access to economic intelligence most people never see, and they're moving assets from dollars to gold, not as a hedge against market volatility, as a hedge against dollar collapse. They see what Warsh represents, they understand that Fed independence was the last credible defense of dollar stability, and they're preparing for a world where that stability no longer exists. Now let's talk about what you should do, not what you might do, not what you should consider, what you must do if you want your savings to survive what's coming. First, understand that cash is not a safe asset anymore, it's a melting ice cube. The longer you hold it, the more value evaporates. This doesn't mean spend recklessly, it means convert strategically. Physical precious metals should be a significant portion of your wealth preservation strategy. Not all. Diversification still matters, but if you're holding 100% cash and paper assets, you're volunteering for destruction. Gold and silver are no one's liability. They can't be printed, they can't be debased. They've held value for 5,000 years across every civilization, every currency collapse, every crisis. The price fluctuates, certainly. We just saw violent fluctuation. But over time, across decades, precious metals preserve purchasing power when fiat currencies do not. Buy physical, not ETFs, not mining stocks, not futures contracts. Physical metal that you can hold. 1-ounce gold coins. American eagles. Canadian maple leafs. South African Krugerrands. These are recognized globally, easily sold, easily stored. For silver, the same principle, 1-ounce coins or 10-ounce bars. Keep some at home in a secure safe. Keep some in allocated storage with a reputable dealer. Do not keep it all in one location. Diversify storage just as you diversify assets. If you're buying now after the recent crash, you're buying at temporarily depressed prices. That's opportunity. But understand, you're not buying for next month's trade. You're buying insurance. The kind of insurance that's worthless until suddenly it's priceless. Second, minimize dollar-denominated debt where possible, but with nuance. Fixed-rate debt in an inflationary environment can actually be beneficial. If you locked in a 30-year mortgage at 3% and inflation runs at 6%, you're effectively being paid to borrow. The real value of your debt shrinks over time, but variable rate debt is suicide. Credit cards, adjustable rate mortgages, home equity lines of credit with floating rates, pay those off immediately, because when inflation returns and Warsh eventually has to raise rates to combat it, your interest costs will skyrocket. The payment you can afford today becomes impossible tomorrow. Third, diversify currency exposure. This is harder for most people but possible. Open a foreign currency account if your bank offers it. Hold some euros, some Swiss francs, some Singapore dollars. Not because those currencies are perfect, they're not. Every fiat currency faces similar problems, but diversification across currencies reduces your dependence on any single government's monetary policy. If you have significant assets, consider international diversification more broadly. Property in stable countries. Business interests that generate revenue in multiple currencies. This isn't about tax avoidance. This is about not putting all your eggs in a basket controlled by a Federal Reserve that just became a political tool. Fourth, rethink your emergency fund. The standard advice says, keep 6 months of expenses in cash. That made sense when cash was stable. It doesn't make sense anymore. Keep some cash, yes, enough for immediate needs, immediate liquidity. But the bulk of your emergency reserves should be in assets that hold value. Physical precious metals qualify. So do certain hard assets. The point is that your safety net shouldn't be made of material that's actively dissolving. Now let's examine the timeline. Warsh takes office in May 2026. His first FOMC meeting where he votes as chair will likely be June. That's 4 months away. Between now and then, the current Fed under Powell will probably hold rates steady. They might even cut 25 basis points if employment data weakens. But the big shift comes in June. If Warsh cuts 50 basis points in his first meeting, as many analysts expect, the signal to markets will be unmistakable. The Fed is now a political institution. Dollar weakness accelerates. Foreign central banks accelerate their diversification. Inflation expectations rise. The bond market reprices risk. Yields spike. And ordinary people holding cash and bonds watch their wealth evaporate. 4 months. That's your window. After June, the dynamics change. Positioning after the shift is harder, more expensive, less effective. The time to move is before everyone else realizes they need to move. The Warsh appointment also creates uncertainty around Fed composition. Powell's term as chair ends in May, but his term as a governor extends to 2028. Traditionally, outgoing chairs resign entirely to avoid confusion. Will Powell do that? If he stays on as a governor without the chair role, he becomes a dissenting voice inside FOMC meetings. That creates institutional tension, public disagreement. Markets hate uncertainty. They prefer clarity, even if the clarity is bad news. A fractured Fed sending mixed signals could amplify volatility across all asset classes. Stocks, bonds, currencies, commodities, everything moves more violently when the institution that's supposed to provide stability is itself unstable. There's also the question of Senate confirmation. Warsh needs 51 votes. Republicans hold the majority, so confirmation seems likely. But some Republican senators, particularly those who've championed Fed independence in the past, might balk. Tom Tillis of North Carolina has already said he won't vote for any Fed nominee until the Justice Department resolves its investigation into Powell. That investigation itself is political theater designed to pressure Powell, but Tillis's stance creates a potential roadblock. If even a handful of Republicans defect and Democrats vote unanimously against, confirmation could fail. Then what? Trump nominates someone even more compliant, or he leaves the seat vacant and tries to run the Fed with acting officials. Either scenario creates chaos. Markets price in chaos with volatility, and volatility destroys wealth. Let's talk about the global implications beyond just reserve currency status. U.S. Treasury bonds are considered the safest asset in the world. Pension funds, insurance companies, foreign governments, they all hold treasuries as the bedrock of their portfolios. But that safety depends on one assumption, that the United States will always pay its debts, not because of moral virtue, but because it controls the printing press. The US can always print dollars to pay dollar-denominated debt. Default is theoretically impossible, but there are two kinds of default. Explicit default, where you say we're not paying, and implicit default, where you pay with currency that's worth far less than when the debt was issued. Warsh's appointment raises the probability of implicit default. If the Fed prints aggressively to accommodate Trump's political goals, the dollar's used to repay bondholders by less than they should. That's theft by another name. And global bond markets are beginning to price that risk. Watch the yield curve. Right now, the 10-year Treasury yield is around 4.5%. If that climbs to 5%, it signals that bond investors are demanding higher returns to compensate for currency risk. If it reaches 6%, markets are screaming that they don't trust the Fed anymore. And if it hits 7%, we're in crisis territory, because the US government's interest expense becomes unsustainable. Right now, the federal government spends more on interest payments than on defense. That's already a problem. If yields spike because of lost confidence in Fed independence, the debt spiral accelerates. More borrowing to pay interest on existing debt. More treasuries flooding the market, yields rising further. A feedback loop with no exit except either brutal austerity, which is politically impossible, or massive money printing, which destroys the currency. There's no good outcome, only degrees of bad. For individuals, this creates a strategic question. Do you own treasury bonds, either directly or through bond funds in your 401k? If yes, understand that you're holding an asset whose value depends on confidence in institutions that are visibly crumbling. I'm not saying sell everything immediately, I'm saying understand the risk. Diversify, shorten duration, move from 20-year bonds to 2-year bonds, or move from bonds to other assets entirely. The goal is to not be the last person holding the bag when confidence finally breaks. There's another angle. The rest of the world has been subsidizing American consumption for decades. We import more than we export. We run a perpetual trade deficit. We borrow from foreigners to finance that deficit. And foreigners accept our IOUs because those IOUs are denominated in the reserve currency. But if the dollar loses reserve status, that arrangement ends. We'd have to actually balance our trade, consume less, export more. The adjustment would be brutal. Living standards would fall. Not for billionaires. They'll be fine. For the middle class, the people living paycheck to paycheck, the ones who don't understand monetary policy and don't realize the game is changing. That's who gets destroyed in currency transitions. Not because they did anything wrong, because they didn't see it coming and didn't prepare. The historical precedent is everywhere. Britain went through this in the mid-20th century. The pound sterling was the global reserve currency for 200 years. Then 2 world wars, excessive borrowing, and loss of empire ended that status. The pound survived, but Britain's global economic influence collapsed. Living standards stagnated for a generation. The adjustment was painful, prolonged, and politically destabilizing. America has more resources than post-war Britain. A larger economy, more innovation, better demographics. But the principle is the same. Losing reserve currency status means losing the ability to borrow cheaply, import abundantly, and export inflation. The transition will hurt. The question is whether you'll be positioned to navigate it or caught unprepared. Kevin Warsh is not evil. He's not stupid. He's a smart, experienced policymaker who believes that Fed independence, as traditionally understood, is less important than aligning monetary policy with economic growth. He sees the institution as having become too rigid, too cautious, too divorced from political accountability. He thinks central bankers should support elected leaders' economic goals, not obstruct them. This is a legitimate philosophical position. Many economists agree with it, but philosophy and mathematics are different things. The math says that cutting rates when inflation is above target creates more inflation. The math says that printing money to finance deficits devalues the currency. The math says that political control of the money supply has never, in all of human history, ended well. Warsh may believe he can thread the needle, support growth without igniting inflation, keep the dollar strong while cutting rates, but belief doesn't change arithmetic. The scenario most likely to unfold over the next 12 months looks like this. Warsh takes office in May. First rate cut in June, 50 basis points. Markets rally initially. Stocks surge because lower rates boost valuations. Bonds rally because investors assume this is the new normal. The dollar weakens, but gradually. Then reality sets in. By August, inflation data shows re-acceleration. Core CPI ticks up from 3.2% to 3.8%. Headline inflation, including food and energy, hits 4.5%. Wage growth accelerates as labor markets remain tight and workers demand raises to keep up with prices. By October, inflation is undeniably problematic again, but it's an election year, 2026 midterms. Trump pressures Warsh to hold rates steady. Warsh complies. By early 2027, inflation is running at 6%. The Fed is trapped. Raising rates to combat inflation would crash markets and anger the president. Holding rates steady allows inflation to spiral. They choose the politically easy path. They hold. And by late 2027, we're in the early stages of the kind of inflationary spiral that defined the 1970s. Maybe not 15%, but 8%, 9% sustained for years, enough to destroy savings, enough to shatter confidence, enough to break the social contract. This is not prediction, this is pattern recognition. The pieces are in place, the incentives are aligned, the institutional guardrails have been removed. What happens next is not mysterious, it's inevitable unless something changes. And nothing is going to change because the political will doesn't exist. Neither party wants austerity, neither wants to cut spending or raise taxes sufficiently to balance the budget. Both want the Fed to make the pain go away by printing money. Warsh will give them what they want, and you will pay the price unless you take action. Your action plan is simple but requires discipline. Convert a meaningful portion of cash to physical precious metals immediately. This week, not next month, not when you get around to it. This week. Open accounts that allow foreign currency exposure. Even small diversification helps. Review every dollar-denominated debt obligation. Anything with variable rates needs to be eliminated or refinanced to fixed rates now. Rethink your asset allocation. If you're 100% in stocks and bonds, you're over-concentrated in paper claims on a system that's breaking. Add hard assets, real estate if you can. Commodities. Productive businesses that generate cash flow in multiple currencies. The goal is resilience, not maximum return. Resilience. And finally, accept that the world you knew, the world where cash was safe and the dollar was king, is ending. Not over years, over months. The appointment of Kevin Warsh is not just a personnel change, it's a regime change. The regime that maintained dollar stability through central bank independence is over. What replaces it will be more political, more volatile, more dangerous for savers. You can complain about it, you can wish it were different, or you can adapt. The people who adapt early, who move before the crowd, who understand that this time actually is different, those people will preserve their wealth. Everyone else will learn the hard way that cash is not safe, that institutions are not eternal, and that when the money dies, it dies faster than anyone expects. The dollar is falling, the Fed is printing, and the window to get out is closing. What you do in the next 72 hours will determine whether you're protected or exposed when the mathematics finally catches up with the politics. The choice, as always, is yours.